Terry Duffy, thank you for talking to Bloomberg.
Thank you, John.
I was looking the other day, volatility has been incredibly low. Last week we had volatility at the lowest ever recorded, the VIX, and yet your revenues have kept on climbing. Can you explain that to me? Why? Surely your businesses are linked to volatility.
Volatility, John, is a component of what we do. It's not everything that we do. So yes, we need volatility to move the markets a little bit so people can manage their risk, but at the same time, you know, there are fundamentals outside of volatility that will move markets, whether it's geopolitical or others. Even though, in light of what's gone on in the world, it's surprising how little markets have been affected by some of the events that, you know, when I first started in this business 37 years ago, would have had a very adverse effect on markets for not just days, weeks, but years to come. And I'll give you a great example. In 1989, when the nuclear reactor in Chernobyl blew up, you know, people believed that Eastern Europe wouldn't be able to grow a dandelion for 10 years, and the U.S. agricultural markets got very, very active, and people were participating in them because of that. And when you look at what's gone on in today's world, there's so many different, whether it's geopolitical, you have the unrest in North Korea, and then our own administration here going back and forth with them. You know, that normally would cause more of a market
Nothing's
surge.
happened.
The market hasn't really reacted to it. You know, the U.S. equity markets have kind of just gone straight up, and the interest rate markets have stayed stable to lower. I mean, it's really surprising when you look at all the events that have gone on, and the markets become just so jaded to it, they don't react to it like they used to.
Two things on that. First, you know, what happens now? Interest rates do seem to be moving a bit. Presumably, from your point of view, that's nothing but good news. But is that going to change the nature of it?
Well, I think what the way it really changes, and even though it could be a small move in rates, the difference is with the U.S. Fed, the central bank in the United States, that was acquiring so much debt in the QE situation for the last several years, has announced that they are not going to acquire any more debt. So everything they have, they're just going to come off their balance sheet, which means that we have to have other participants come in and assume those auctions and debt issuances to take it up, so the private sector. What's interesting about that, the U.S. has the only central bank in most of the countries that does not hedge. So the central banks throughout the European Union, they all use hedge vehicles. The U.S. central bank doesn't hedge, so they assume all the risk on their own balance sheet. So now that risk is going to be turned over to other participants other than the U.S. government, we think that even with the smallest of rate environments that's gone up or down, that we're going to see more people hedging that, because they're not going to be able to hold it like the U.S. government can without hedging it. So we think that'll help the trade continuously move forward.
Where else do you think volatility could appear? I mean, you pointed out the geopolitical risk, but are there particular markets, particular asset classes where you would, all other things being equal, expect volatility to come back a bit?
I would. I'd expect all other things being equal. I would see it more in the metals markets. I would see more volatility. I would see more in the energy markets. Even though that was probably the biggest volatility that nobody talked about, which was in the last 2 years, when you saw the price of crude oil sit between $92 and $102 a barrel for 3 straight years, went to $26.50 a barrel in a very rapid way. So that to me was a huge volatility in the overall marketplace, was in the crude oil market. So that's one thing that I can't imagine we're going to continually sit here at $48 to $52 a barrel again. I think we're building a new normal, for lack of a better term. You get more exploration here in the United States. The input costs continue to go lower, so more people get into the business. So now you look at people that have the product, whether it's in Saudi Arabia or other Arab nations that rely on the oil revenue as their only way of producing any revenue, that they're going to have to do something about that to keep their market share. So when the U.S. explorers were in there at $92 a barrel, their break-even was supposedly around $80 a barrel. Well, the Saudis took the prices down, and they're going to have to continue to do so if they want to maintain their share of the overall market. So it's going to be an interesting phenomenon in the energy space.
But do you think there are any asset classes where you feel sort of weak when you look at your portfolio of places where people can trade? Are there bits where you would like to have more? So it's capacity.
I mean, you'd like to see more activity in all the asset classes, but you know, one of the things, John, that we've been really successful at, when you look at interest rates, we talked about them not doing a whole bunch, but we've been able to create new vehicles in the interest rate products, so maybe a derivative of a derivative. So whether it's the ultra 10-year bond that's been very, very successful for CME, on-the-run treasuries, things of that nature that we've created here over the last several years, where people may not be trading the traditional 2, 5s, and 10s and 30s. They're now trading these other instruments that reflect the interest rate product. So that's been a big success for us here. So we continue to innovate within our own asset classes and outside to grow the business.
What about cryptocurrencies? I mean,
Yeah,
now you've got your neighbors in Chicago. They're talking about doing a futures contract on Bitcoin, but you've come out saying no.
No, I don't think we came out and say no.
Not yet.
I don't think we came out and say no. You know, from my standpoint, cryptocurrencies, listen, I've learned a lot about them over the last several years, like everybody else has. I think when you look at currencies such as digitized assets and cryptocurrencies, you can imagine if you go back in time when someone pulled out the first credit card and someone said, what is that? And someone pulled out the first paper check and said, what is that? So you read about how many currencies are in the world today in circulation. There's 1,146 currencies in circulation today. It's a really an astounding number to think about that. So, and that's not including wooden nickels. So maybe 1,147. So, but there's 1,146 currencies truly today in the world. So cryptocurrencies are one of those vehicles that people feel is not going away. So we've had people say that they are tulips. We've had governments come out and say we are no longer having ICOs in China. We had Russia come out today and say that we want to ban this type of currency.
Jamie Dimon called them a fraud.
Well, you call them a tulips. They're tulips, yeah. Right? So, and then Russia came out and made some conversation about them banning them. I didn't get the whole story today. And the market went down significantly, but there was people right there to buy it, and they brought it right back up to the same levels as today. So that tells me in and of itself that, you know, people want to see what the end of the game may or may not be here as far as cryptos go. And I don't believe that we've seen the end result of this yet.
But you don't have any immediate plans like the CBOE to do a futures contract?
The CBOE filed an application at the CFTC in order to trade this vehicle, but you know, from our standpoint, we're taking a very methodical look at it, and we'll make that decision when the time is right. But, you know, I'm not prepared to sit here right now and tell you yes or no.
But ETFs, the other great asset of choice at the moment, is that something you would like to push into? You
know, we compete with the ETFs significantly, you know, especially in our equity products. And when you know, there's been a debate for many, many years, are ETFs more cost effective than using the E-mini S&P futures contract? And I think when you look at the pure transactional cost and the liquidity of futures, that we have been deemed as a more cost-effective way to manage your risk especially in the equity components of the ETFs. So there's other ETFs, whether they're in commodities or other products, that are continuing to trade. But as you know, most ETFs, John, are very illiquid in nature. There's a handful of them that are very successful. BlackRock has been very successful in the ETF business. But there's a handful of them that generate most of the revenue. A lot of them are illiquid in nature.
But do you worry about them on that basis?
I don't worry about them. I look at them as more complementary in nature, to be honest with you. I think that, you know, our products have become more mainstream than, you know, just as little as 10, 12 years ago. And when you look at the biggest growth in our world, it's been on the options side. Yes. So options on futures has been exploding at CME Group. That's one of the reasons our volume is continuing to grow up, especially in a low volatility environment. Options become very attractive for our participants to be involved in. And when you look at, you know, my neighbors down the street at CBOE and their options business, it's done very well. So, you know, I think options are something that's very complementary to our business, and ETFs are, you know, in that same bucket.
But do you worry from a financial stability point of view about ETFs? Are they the next? I mean, the way you describe them slightly is an illiquid thing.
Well, I didn't say they're all illiquid. I think there's a lot of ETFs that are listed, but it doesn't mean they're all illiquid. There are quite a few that just don't trade very much or trade at all, or may trade once a day or once a week. But a lot of them trade significant volume on a daily basis, depending on which ones. But there's a lot of ETFs that are listed.
You don't think regulatorily they are somewhat favored over some of the things you do?
Yeah, but I think to answer your other question, I don't think that they're a risk, if that's what you're referring to a crisis situation where the ETF market starts to crumble. You know, I think you have a scenario like that, you'll see other asset classes leading the way, not the ETF market.
Interesting. And I wondered another way in which you could expand your portfolio, of course, is by mergers. You did a lot of deals, and then 2008 you seemed to stop. We had the talks with ICE last year. the owners of the New York Stock Exchange. Is there another kind of big deal brewing? Is there something that you could fill in holes with?
There's been no confirmation of any conversations with the Intercontinental Exchange, just so we're clear on that one. Yeah. Yes, we were very aggressive in 2007, 2008, doing transactions that might have been impossible to do in today's world. Cross-border transactions have been proven to be very, very difficult in nature. So when you look in the United States about M&A activity with other exchanges that can create the synergies and for not only your shareholders, but more importantly, you have to create a value proposition for your clients to trade it in a more efficient way. And that's normally what the M&A activity that we have done, that I've been able to lead here in 07 and 08, was more based on the fact that give our clients the opportunity to cross-margin treasuries against Eurodollars, the cross-margin the Dow futures against the S&P, things of that nature, the grains against the livestock. That made so much sense from a client perspective, and then in return it paid our shareholders handsomely to do those transactions. So that's kind of how I look at that. And then when you look at cross-border today, first of all, the Toronto Stock Exchange tried to do something with LSE, and they stepped in and said no. The Toronto bankers decided they're going to keep the exchange up there. Back when the New York Stock Exchange was trying to do a deal with Deutsche Börse, and Deutsche Börse stepped in, and the regulators stepped in and said no. And so it's very difficult to get some of these transactions done today, especially cross-border, and that's really the ones that are left out there. And now with the uncertainty of Brexit, it even makes it more complex.
The Deutsche Börse, LSE, what were the lessons you drew from that? That it's now almost impossible.
Yeah, I wasn't a bit surprised that they finally had to call it quits on that one. I mean, I think they fought it to the end, but at the same time, it looks like it made a lot of sense. But if we knew that Brexit was going to happen prior to that transaction being announced, you probably wouldn't have gone down that path, right? So I just think there's a lot of issues out there right now with nationalistic protectionism. They look at these institutions as part of their makeup of the fabric of their countries. I think Germany does for sure. I'm not so sure they look at it the same way in the UK or the US, but definitely other parts of the union they do.
If you ask people here, they will always talk about you getting together with CBOE or getting NASDAQ, I suppose ICE as well. Is that really where you're limited to if you have to look inside America?
No, I don't think we're limited to anything. I think one of the things that we've been very fortunate to do is put ourselves in a very strong position to analyze multiple different transactions, if in fact that was the opportunity that presented itself. So you named a couple of them. It doesn't mean that's the path we would go down. There's a lot of other things that we can do to create the value for our clients, which, like I said, in return will deliver value for my shareholders. And that's really what I'm tasked to do.
Do you think there's anything happening? I was in Europe last week. In finance, you've now got the beginnings of banks beginning to do a few cross-border things. You've got talk of Commerzbank becoming available, maybe Italy or France buying it. There's just the first signs that the sort of rationalization, cross-border rationalization you would expect in a relatively global industry like finance to happen. Do you think the time will come back when cross-border exchange mergers will be possible again?
I think when you hear some of the rhetoric, and I don't want to call it rhetoric because it's coming out of politicians. I shouldn't have said that way, but that's okay. I said it. There's politicians, especially in Germany and Hesse, that said that no way in hell is Deutsche Börse ever leaving Germany. I mean, it's not going to happen. So when you look at an exchange like Deutsche Börse that's got a market capitalization around $14 billion, and then anybody that they want to potentially do a deal with is much, much bigger, well, they're not going to remain in Frankfurt. So that's an immediate problem right there, when the people that have to approve these transactions are saying you can't leave my jurisdiction. And so you look at the labor laws in certain parts of the world, and you have to figure that into the equation when you decide to move forward with these cross-border transactions, if you want to do them or not.
Do you think Asia is more promising than Europe in that way?
I think Asia is just a little bit different right now. I think, first of all, they had a very similar situation with the Singapore exchange and the Australian exchange. As you know, they announced that they wanted to do something together, and the Aussies stepped in and said no. So that was a bit surprising when I saw that. I didn't see that protectionism coming in, but it did. So maybe they're not a whole bunch different. You look at all the exchanges in China. I think they want to be the price setter for products around the world. And right now, the United States and parts of Europe really enjoy being the price discovery centers for products around the world, which gives, in my opinion, a great benefit to our nations to be able to set those prices.
But if cross-border M&A was allowed, would that make the system both safer and more efficient?
That's really, well, first of all, it's not allowed. It's just difficult to do.
Yes.
And I don't think it changes the security of the systems, if cross-border deals were done or not. First of all, CME is already a global institution with people all around the world, clients in 200 countries around the world. So we are already a global institution trading around the clock. Roughly a third of our revenue comes from outside the United States today. So you don't need to do a cross-border deal to be a global institution. And I think as far as making it safe, it's all in your risk management and the protocols that you have in place. I think that's critically important. So I'm a big risk guy. I want to make sure that we manage risk properly. And I don't believe in taking shortcuts when it comes to risk. So I don't want to race to the bottom on margins. I don't want to race to the bottom on regulation. People have said to me for a long time, what about the regulation? And they're very strict. And I said, regulations lead to credibility in the marketplace. Credibility leads to more business. So I actually embrace good, smart regulation. I don't embrace duplicate regulation. I don't embrace regulation that makes no economic sense. But for the most part, if you look at the history, especially I won't go off of the U.S. because we're here now, but if you look at some of the modern day regulation, in 2003 we had Sarbanes-Oxley, and after the scandal that happened with Enron in Anderson Accounting. So now we have what's called, as you know, 404 accounting here, which was very difficult to account for about how much you're going to put forth. So the pendulum was way over here on Sarbanes-Oxley, but it kind of swung back gradually, and now we don't even talk about it anymore. So now we have good, smart regulation. It's stricter, it's harder, and it's tough to be in compliance as a public company like we are. I have to sign off on these reports, and you got to pay attention to them.
What about Dodd-Frank? My memory is that
I was going to go to that.
Dodd-Frank, as I understand it, you would like to see change, but you don't want to see it repealed.
I did not testify in favor of Dodd-Frank. Yes. I was a big believer that the market should put economic incentives into. I'm going to the clearing component of Dodd-Frank.
Yes, exactly. The clearing,
because that really was the biggest part that influenced.
And that helped you.
Right. Well, I don't know if it helped us because our revenue associated with swaps clearing is not that big compared to LCH or compared to the Intercontinental Exchange. Our revenue is more based on transaction of our base business, not on swaps. So, but I said that if you don't want to clear swaps, then you should put up X amount of capital, and if you do, then you put up less. And make it that simple. But to have the government mandate it didn't make a lot of sense to me. Meanwhile, I think that if we didn't have regulation in 2010, we were getting ready to knock ourselves into the Stone Age, and we were real close to it at the time. So you had to have change, and I accepted that. And so when Dodd-Frank happened, you look at the rest of the world wasn't doing anything at regulation, and you look at Europe right now, they're just now introducing MiFID II and some other new regulations, which there's a lot of uncertainty right now in Europe, and that makes it difficult for the participants when they're uncertain of what the rules of the road are going to be. And that's what we faced here in the United States in 2010, I would say through 2014. And now that's mostly behind us. And it's not where the laws are any less than they were in 2010. Nobody's done any deregulation, maybe even counter to what the administration is saying right now that they want to deregulate Dodd-Frank. Nobody's really done anything.
Yeah.
The people have become more acceptance to the rules, and they're in compliance with the rules today, and this is part of life. There's an additional cost. We all don't like higher costs, but at the same time, we've also garnered more business because of the credibility of our marketplace.
Is there if I was Trump and I was sitting here, or Mnuchin, is there a particular part you would like to change of the current regulation, which you think would be not necessarily good for you, but good for the market?
I think what's good for the market is to make sure that you don't limit participants to the marketplace. I think liquidity is critically important, and when you limit participation and then especially in times of stress. When things are like they are right now, where we got low vol and not much is going on, but if you get into times of stress, you want to make sure everybody is in the marketplace that can provide liquidity.
And are there particular bits of Dodd-Frank
or
whatever
that
stops that?
It would go to the Volcker Act. I think the Volcker Act, the way it was written, was ill-advised at best. I didn't support that. I believe that the banks should be allowed to prop trade. I think there's nothing wrong with it as long as they're regulated like everybody else. That their liquidity is critically important to the marketplace and for the security of the marketplace. So I didn't like seeing them taken out of certain asset classes. So they could prop trade. Here's a great example. You could prop trade in U.S. Treasuries on the cash side, but you cannot prop trade on the future side of U.S. Treasuries. So someone would say, well, that's no good. Well, we went from 47% of the U.S. Treasury trade in the United States at CME. Now we're 87% of the trade on the U.S. Treasury market. So when you look at some of our counterparts in Europe, they're at about 400% of the trade. So we are really starting to move forward in that direction. And I'm not sure if that's because of the laws or just because of the efficiencies of the pools of liquidity. But my point is we should not have the banks eliminated from those pools of liquidity, because even though we're not moving a lot right now because of the vol that you mentioned, yes, stress will come into the marketplace and you want those people in there.
You mentioned MiFID. Again, every financier at the moment is either worried or concerned about it. What's your biggest sort of worry, and what do you think the best thing to come out of it?
My worries are pretty limited since I liquidated my exchange over there.
Yes. But all your clients are involved in it, though. The
clients are involved in it, but they don't need to be in compliance with MiFID when they trade my products here in the U.S. They got to be in compliance with Dodd-Frank, which they already are. So it really doesn't have any effect on CME Group, other than we have clients that are looking for us to help give them some direction on some of the products they're trading in Europe. But I'll be honest with you, John, it doesn't have any effect on CME Group.
About Chicago, I just struck being here. What you mentioned earlier, not having pits and things. What are the reasons really to be located in Chicago from the point of view of the trading side? As you said, there's very little physical trading. Most of your thing is in a data center out in the suburbs. Why Chicago?
I think that the simple answer is if you were to whiteboard it today, you probably wouldn't pick Chicago. And it's nothing against the city of Chicago, but this is a legacy situation. There's no question about it. And others might point to the great universities we have there. You could point to the diversity of the businesses here. That's not a one-trick pony. It's not a financial services town. It's not a advertising town. It's not an insurance town. It's all the above, right? So it's got multiple different industries located here in Chicago. So that's what people would point to as why it's so good. I don't disagree with any of that, but I think as a financial services industry, as a neutral facilitator of risk management, you'd probably be out of New York or another location. But we're here for legacy reasons, and now that we are here for legacy reasons, it makes complete sense because of the other things I just outlined. The university system is second to none right now. When you got the University of Chicago, Loyola, Northwestern, all the premier universities, you get a talent coming into the city. I think Chicago's become much more livable, contrary to the press that's portrayed it as a war zone. It's not a war zone. I mean, there's crime in every city in the world, so that is what it is, and we got to deal with that. It's a separate issue. And, I hate to say this, but I think global warming is real because our winters are becoming like Miami Beach around here. It's just ridiculous how pleasant it is.
I look forward to testing that, but the very obvious problem, though, is that you've got a state government which maybe, you've got people talking about financial transaction taxes. Are those, that's a very powerful negative against Chicago,
it is, John, but I think that, it doesn't prohibit another state from having the same conversation if you were to go there. Upstate New York has done a really good job of attracting businesses. Manhattan's very expensive, as you know. I mean, you look at London, it could be very expensive over there. So yes, our legislature is in search of money, and they're looking for bright, shiny objects in the room. We happen to be one because we're a global company, but when you go to them, and I spend a lot of my time trying to educate people about what the benefits of our industry are, what the benefits of we are headquartered right here in Chicago, and I think they start to, for the most part, get it. There's those that will never get it, and they have their mind made up that they want to try to bring some kind of a user fee or tax to our industry. And I get that, but I think there's enough people to understand the benefits of CME Group being headquartered here in Chicago. And also what is important is we don't own any real estate in Chicago. We don't own any trading pits in Chicago like you referenced earlier. It would have been very difficult for me to go to the state legislature and say, you know what, I'm going to move, and I got to take 6,000 traders with me and disrupt their families. That's not the case anymore. You know,
so it makes it easier for you to go.
We don't own it. We sold all of our real estate in Chicago. We sold our data center. We sold everything. We have an agreement with the people that own that data center. They own 22 other data centers in the United States. They can move us into any one of them. So we don't have the same restrictions that we may have had a couple years ago. So the threat of them saying that we can't leave because of what we have here, I always say we don't have anything here.
Duffy, thank you very much for talking to Bloomberg.
Thank you, John. Appreciate it very much. Thank you, sir.